Micron. As of this writing, the stock has nearly tripled since January. Everyone is talking about Micron. YouTube, news, your neighbor, colleague in particular, they're talking about how you've missed out a big time if you haven't bought the stock. But that's not why I'm here and not why you're here either. I have read theirs and others' earning calls in the last few days, and in this, I am going to explain to you a few things. Why does it suddenly get so much attention? Why does the stock price boom? And why does AI make this RAM shortage worse? How this memory party is not a good sign for any company who adopts AI, and even worse news for AI labs. And finally, what to look out for. Let's start with who Micron is in 30 seconds. Think of it as one of the companies building plumbing behind AI. If NVIDIA's GPU are where the visible action happens, Micron's memory is what moves the data and feeds it to the GPU. And one doesn't work without the other. And as AI shift from training models to actually serving answers all day, memory becomes even more important. So the market is finally realizing that if everyone needs more AI hardware, everyone also needs more memories. And Micron just released their latest earning reports. It turns out that isn't just their stock that is popular, but their products as well, to an extent that a third of their products over the next 5 years are booked and totaling $100 billion committed. So now we know what Micron sells. Next to ask is, why does the industry suddenly treat memory like a scarce asset? The bottleneck. Historically, memory has been cheap per bit. That was basically the whole industry models. DRAM is in anything with a processor that runs software. Just think your smartphone, your laptop, game console, smart TV, and even your cars. For the last few years, the focus was all on GPU. So story was getting more NVIDIA GPU to build data center, and with more demand, the token costs will also keep falling. That was the whole story. But that version leaves out the boring part that suddenly matters a lot in 2026. A GPU is only useful if you can keep feeding it data. So the more AI shifts from training models to serving answers all day, the more memory becomes the choke point. Every prompt, long context window, agents, or answers being generated token by token has been held, moved, and pulled back fast enough from the GPU to use it exactly via everything the companies like Micron, SK Hynix, and Samsung sell. NVIDIA's product still practically does the math. But Micron is the part that keeps the data pipeline from drying up. And this is where the story gets interesting, the dynamic. Memory demand is exploding, but memory supplies takes years to build. You can't just make more memory chips with a snap of a finger, because there is a long list to tick before production can start, such as fabs, cleanroom equipment, power, permit, or skilled workers. Then you need years before those factories are producing usable chips at scale. And it gets worse, because each new generation is more complex than the last. Manufacturing only gets harder. Instead of following the pattern that we've been so used to for the last 60 years, Micron is telling investors that the blended DRAM cost per bit is increasing by between 60 to 80%. And this isn't unique to Micron. Its memory peers are pointing in the exact same direction. For example, Samsung has warned that memory supply still falls short of customers' demand and that the gap will keep widening in 2027. The same for SK Hynix. They sent a very similar message to their investors and saying that it expects demand to outstrip supply for at least the next few years. So with Micron, they also put this message in their reports, said there is no clear line of sight for when supply actually catches demand. Since the demand is loud and clear and the supply only arrives years later, market forces do what they always do. They push the price up. And AI makes this worse because it does not just need normal memory, it needs the expensive stuff called HBM. It's high bandwidth memory, a memory that is complex and costly, but it's best suited to relieve the memory/GPU bandwidth bottleneck for AI chips. But making HBM isn't an easy task. In particular, it needs more factory capacity than regular DRAM. So the more industry shift capacity towards AI memory, the more pressure it puts on everything else. Naturally, it hits servers, phone, PCs, cars, industry systems, basically anything that has a processor. And if you're in one of these industries, you really don't want to get caught without enough memories. Just look at Apple. They've been paying up just to lock up DRAM supply, and ASUS has basically been stockpiling chips like a bank run. So that's why exactly this earning report is so important for you to understand. It shows how keen Micron's clients are to sign supply contracts with them, because there's no customer sign multi-year agreements just out of generosity, only when they are more scared of a shortage than oversupplying. And the contract detail I'm about to reveal are even stronger proof of how eager they are to reserve the supply. So exactly how unusual are the commitments? The stock price boom is not just due to Micron's last quarter's earnings, but also to the future cash flow implied by customers locking in scarce supplies years ahead. Because every major player now knows memory is the bottleneck. In this report, Micron said it signed 16 strategic customers agreements with customers across data centers, consumer, and automotive. And 14 of those have committed in total of $100 billion of revenue at a minimum contract price. Minimum. I emphasize this because this $100 billion is the worst case scenario for Micron based on the minimum volume and the price in the contract. It can only improve from that point. There are 4 details in this paperwork. Once I pointed them out, you will see how obvious this is and how desperate their customers are in those memory supplies. So detail number 1, the deposit. Micron expects around $22 billion in deposit and related finance commitment. So rather than a handshake and a ceremony, the customers are putting money behind it. Detail number 2, take or pay. And the structure matters because, as what I've already explained in the SpaceX and Cursor video, the take or pay contracts is the exact same type of the contract signed by Micron's customers. In short, their customers have committed to buy a certain amount. Even if they didn't end up taking any of this, they still have to pay. But you will probably ask, why would customer even agree to that? It's all for peace of mind. They're buying the rights to know they will actually get memory when they need it. Detail number 3, the floor pricing. There is a ceiling price that protects the buyer. And it says if the memory becomes more expensive, my price cannot go above that level. Equally, there is a floor price that protects Micron. It says if memory price collapse later, you will still pay at least this much. So the buyers pretty much gave up the upside if the price fall because they're more scared of what happens if the price rise or the supply is just simply not there. While Micron gets guaranteed cash flow early, which they will probably use it to expand their production. Now, detail number 4, locked in at a tight market price. You have thought, okay, but maybe customers are just buying in at a low point. But in reality, Micron just reported DM's price rise in 60% range quarter over quarter and NAND prices up 80%. So this does not look like customers locking in a bargain price. The contracts are built around today's tight market. That tells you how they see the market. They're thinking the memory is expensive and it might get worse. So if we don't reserve supply now, someone else will. So far, it sounds great for Micron. However, is this also unicorns and rainbows to everyone else downstream? Micron is great if you're Micron, and it's probably fine if you own NVIDIA. The demand for hardware is still there. Most people assume inference only gets cheaper over time and have built businesses or even adoptions around this theory. But what if memory stays scarce or it doesn't get cheaper fast enough? The assumption would just fall apart. This is the exact pass-through problem that you will be seeing in the next few months or even years. Basically, the companies building products on top of the memory have to choose among these 3 options: absorbing the cost, raising the price, or produce less. Here are 3 downstream categories that have already seen or will soon run into this issue. First up, the warning from the chip manufacturer. AMD, who is specialized in GPU, has already warned this higher memory and components cost that are affecting its customers. Or Apple, you probably heard of this, that they have already raised the price of its devices, citing memory cost as the reason. AI Labs face the exact same issue, just at a much larger and more strategic level. And here's our second stop, the margin problem for the AI labs. The frontier labs are still trying so hard to turn usage into durable revenue while carrying enormous infrastructure costs. So if memory keeps the cost base elevated, the labs have less room to subsidize their customers, while putting more pressure to prove their investors that each token sold has a decent margin. So again, the memory stocks are going off topic. It's just a too simple one. I'm glad you're here for substance. Before we continue, please share this with someone who would also appreciate this analysis. Now, once the labs has less room to absorb the cost, the pressure shifts to their customers. Now, here comes our third stop, the ROI problem for the enterprise AI users. A lot of AI budget has one hidden assumption, is the inference get cheaper over time. Maybe not quarterly, but eventually. The model gets better, the hardware gets better, a task gets more efficient, and the same workflow costs less next year than it costs today, as many AI leaders like Nadella has been citing Jevon paradox. However, this assumption isn't true today in 2026, and is not going to be true either in 2028, especially when many AI use cases are still borderline. Those use cases work in a demo, in a pilot, and when vendor is subsidizing heavily the price because everyone wants adoption. But at a full scale, with thousands or even hundreds of thousands of requests, you will now have real latency problem, a real infrastructure cost to pay, and that's when the ROI becomes a question mark. I don't mean to say that the token price can never fall. Software efficiency can still help. For example, we're looking at smaller models, caching, better routing between models, and of course, once the memory supply pipeline is resolved, it will certainly help as well. But it also means the token cost decline isn't automatic. If you build your AI roadmap assuming the inference cost is always going to fall, you should be worried about the warning from the memory manufacturer that the hardware may not deliver the discount you've been hoping for. So the first things to break will not be these obvious use cases like customer support, coding tools, search ad, basically things that was sort of labor saving. However, I see the following at immediate risk. The weaker use case, the agents that save 10 minutes but needs to run all day, plus the kind of internal chatbots that is just revising your email and drafting your report. Basically, the workflow has no clear payback period, even under the most optimistic token pricing. If inference costs remain higher for longer, those projects will be delayed or narrowed, or the chief product officers will just have to be more careful about what to commit to. And again, I'm not saying that this will cause AI demand to vanish. Demand can be real, even it isn't clear on the ROI question. So what to look out for next? So we've answered the first three questions: why Micron matters, why stock moved, and why the AI leaders may already understand the trap they're in. The next question, and the final one, is where does the AI industry go next? I'll watch these four things. 1. Memory supply. If Micron, SK Hynix, and Samsung can add enough capacity by 2028, the pressure can be eased. If they cannot, expensive memory becomes a longer-running tax on AI infrastructure. And that matters, again, because the inference will get cheaper over time assumption and the few paths for AI companies to really become profitable. Second, the token pricing and the lab margins. If OpenAI, Anthropic, Google, and the rest are trying to keep price in an affordable range while infrastructure costs rise, then someone is going to absorb the pain. Maybe software efficiency offsets it, maybe smaller model, caching, routing, and MOE keep squeezing more out of the same hardware, but if none of it keep pace with the price hike, the margin will get squeezed. And that is the trap for frontier labs. They need more and better models to stay ahead, but better models are expensive to train and to serve. If customers have already become more selective about ROI, the labs get pressured from both sides. Now, the third one to watch, substitution pressure across the stack. When one input gets more expensive, the market doesn't just pay forever. It starts substituting. That said, most people didn't realize when they think of substitution, the ROI could be messy because every substitution comes with its own trade-offs. A few examples that I have seen. Start with the first one. Lab has changed how inference is run. They batch more requests, and they have shortened context where possible. They also keep repeating answers in cache. For example, the AI video summary feature on YouTube. Second, the open weight reduces dependency on OpenAI and Anthropic, but they still need hardware. And third, local AI avoid some cloud inference costs, but you also require more memory on the device. And fourth, edge AI helps the privacy and latency, but it also pushes memory demands into phone, PC, cars, and industry equipment. And finally, the customer chips that may reduce dependencies on NVIDIA over time, but they do not remove the need for HBM, DRAM, power, networking, and data center capacity. Oh, by the way, before we continue, please subscribe so you don't have to keep track of all these evolution, but I can do this for you. So the workaround markets basically tell you how painful the bottleneck is and where they're about to push it. If you believe there is any company that isn't worried about cost, that they would just use the best model forever for everything, that you are a fool searching for the perpetual motion machine. It's against the natural law of economics, basically. And since the pressure is across the whole stack, models, memories, chips, cloud capacity, edge devices, so who gets access to the scarce supply will be in a much better position than their peers. Which brings us to the next nature points to watch. Fourth, who controls the bottleneck? This may be a more strategic shift than you would ever think. As I said, the trade-offs. Open weights are useful, but they still need somewhere to run. Local AI is useful, but it does not solve enterprise scale without a huge cost and overhead. Edge AI helps with privacy and latency, but it also increases memory demand pressure on phones, PC, and cars, and whatever I already talked about. So the workload keeps finding its own way back to infrastructure. This gives more power, of course, to hyperscalers like Microsoft, Amazon, and Google. And of course, the neoclouds underneath them, increasingly, they're looking for their own vertical solution. Just like Google has TPU and Amazon has Trainium. OpenAI is also now doing the same thing, working with Broadcom on custom inference silicon. Because renting the frontier stack forever is too expensive and too strategically important to leave the entire outside of the company. And that's why the frontier labs are in the hardest seat, because they don't have the cash cow revenue stream, while the ecosystem demands them to spend on building their own stack. So my final takeaway here is real simple. Always look for where the bottleneck sits, who controls it, and where it's shifting to next. Here's one open question to you. Do you think there is a scenario in which models stop growing because the bottleneck gets too expensive to expand? Now, I hope you really enjoyed this one. Please do subscribe and watch more here.